Welcome back to financial management class. This is the module 6, where we'll be talking about cost of capital, and where we'll be talking about key concepts uh, of cost of capital, uh, such as equity, debt, preferred stock, WACC, and MCC. We'll look into this very well, and the model identifies um, and calculate the costs of different capital sources. I understand how capital structure affects overall financing costs. It applies work in investment appraisal and corporate valuation, and lastly, assess the impact of marginal financing on firm decision making. So the concept of costs of capital stand as a cornerstone for strategic decision making. So whether a firm is evaluating a new investment opportunity, determining its capital structure, or assessing the viability of merger and acquisition, understanding cost of capital is very, very essential, and that is why we need to discuss it under financial management. So what are the components of capital structure? What are the components of capital structure? Just like I said, we have cost of equity, we have the debt, we have the preferred stock. Understanding these individual components of a firm's capital structure is crucial for accurately estimating the overall cost of capital, just like I've said. So each of these three have their distinctive characters, risk profile, and cost implication. This will just be an introductory aspect of this module. The note shows the well explanation of each of the concepts that are stated here. What is cost of equity? It is the return required by shareholders for investing in a firm's equity. So this is a return which is expected by the shareholders that invested in a firm's equity. So that's the cost of equity, and it incurs higher risk than debt. When we compare it to debt, it incurs higher risk than it, and it is compensated via dividend and capital gains. So that's about costs of equity. What are the methods of estimating cost of equity? We have three stated here. We have the CAPM. As explained before, we have the dividend discount method model, and then we have the earning yield. The CAPM is the most widely used method because it incorporates systematic risk, which is better, and adjusts for market conditions. Also, we have the dividend discount model, which assumes the firm pays dividend and that those dividends grow at a constant rate. And lastly, as for method of estimating cost of equity, we have the earning yield. This is a simplified approach useful when dividend or better information is not available in getting the cost of equity. The cost of debt, and this is the effective rate that a firm pays on its borrowed funds. So if perhaps a company, an institution borrows a fund now, the effective rate which is being paid on that borrowed fund is the cost of debt, and the after tax cost reduces the actual expenses for the firm. That is, the cost after tax, when it is being deducted, it reduces the expenses that is on the firm. And for the formula, we have a formula stated there as KG, and as it represents cost of debt. The KD represent cost of debt. So that's cost of debt after tax, and cost of debt for pre-tax times 1 in bracket open 1 minus tax rates. And we have it as example, if a company issue bond with a coupon of 8% and a tax rate of 30%, the after-tax cost of debt is what? And a KD is equal to 0.08, which is 8% times 1 minus 0.30, which is 30% of tax rate, which gives us 5.6. So in estimation, use yield to maturity on existing debt instruments or new borrowing rate. So to estimate, we use the yield to maturity, which is used for existing debt instruments, and then we use the new borrowing rate also. The cost of preferred stock. It is a hybrid security with characteristics of both equity and debt. So it combines both equity and debt, and it's a hybrid security with characteristics of these two that I just mentioned. So it typically pays a fixed dividend and has a claim on assets to common equity but subordinate to debt. We have the formula also there. So the cost of preferred stock is equal to the annual preferred dividend divided by market price of preferred stock. And what are the features of cost of preferred stock? We have the fixed dividend. It's fixed. It has fixed dividend. No growth is assumed. It is non-tax deductible, and lastly, it lies between debt and equity. So the features are that it has a fixed rate of dividend, fixed dividend. There is no growth assumed for the cost of preferred stock, and it is non-tax deductible. And lastly, risk lies between debt and equity. It is being shared between the two of it. And for risk, preferred stock risk level is moderate. Actually, it is moderate and has fixed return, but subordinate to debt. That's fixed return, but it's subordinate to debt. So we have more of it in the notes, and you can go through. We have the weighted average cost of capital. The weighted average cost of capital, which is the WACC. The weighted average cost of capital is the average rate of return a firm is expected to pay to all its security holders, including equity holders, debt holders, and preferred shareholders. So it's a sum of average rate return that a firm is expected to pay to every of the holders, both security of the security holders, both equity holders, debt holders, and the preferred shareholders. And it is used as discount rate in investment appraisal and valuation. Also, you can see calculations of WACC in the notes. It is well explained there. It is used in why is WACC important in financial management? Why is it important in financial management? First is it is used in net present value and internal rate of return computation. The second is that it helps determine whether to accept or reject a project. So WACC helps to understand or determine whether to accept or reject a project. It serves as a benchmark for performance and value creation. And lastly, it aids in evaluating capital structure decision, which is debt versus equity financing. On the final note, we will be talking about the concept of marginal cost of capital, which is the MCC. The marginal cost of capital refers to the cost of obtaining one additional unit of capital, or the cost incurred by the firm to raise the next 1 naira of financing, and it reflects the incremental cost of new capital, not average capital. And you can see from the table, we have a capital raised in million for uh, from 0 to 50, having a cost of capital of 100, 10%, 51 to 100 million, having 12% cost of capital. And we have a 101 to 150 million, having a cost of capital of 15%. To explain this, it means that the first 50 million can be raised at a 10% marginal cost of capital. Uh, don't forget I said that the marginal cost of capital is the cost of obtaining one additional unit of capital or costs incurred by the firm to raise the next 1 million, 1 naira of financing. So we say the first 50 million can be raised at a 10% MCC, while the next 50 million at 12%, that is the addition. We've already raised the 50 million. So if we'll be raising another 50 million, it's amounting to 100 million, and we will use the 12% rate of cost of capital. And if a new investment requires 120 million, the average cost up to 120 million will blend this rate, but the marginal cost for the last 20 million would be 15%. In conclusion, cost of capital guides investments, financing, and valuation decision. So WACC and MCC are essential for maximizing shareholders' wealth. These two are essential for maximizing shareholders' wealth. Understanding these concepts supports sustainable growth and success. And that brings us to the end of the class for the sixth module. Next class, we'll be talking on the capital structure decision. Thank you.